Hello everybody, my name is Callum Allen. I'm a partner in EY Africa's Corporate Reporting Services team and also a member of the Financial Instruments Working Group. Today I'm with Laura Elliott in our office in central London to talk through the IASB's amendments to IFRS 9 and IFRS 7 for contracts referencing nature-dependent electricity. Laura is also a member of our Financial Instrument Working Group. The amendments were issued in December 2024. And today we'll discuss the amendments and the practical considerations related to them. This video was recorded in May 2025. Laura, would you give us some background as to what the amendments are and why the IASB embarked on this project?
Sure, Callum. So entities are entering into more long-term renewable electricity contracts to secure the supply of green electricity, to obtain renewable electricity certificates, and to manage the price risk of renewable electricity. As a result, there's been an increase in the questions relating to the accounting treatment for these contracts. Now, one question has been what the appropriate treatment is for these contracts to buy or sell electricity and whether or not they're in the scope of IFRS 9. So as you know, IFRS 9 excludes from its scope contracts to buy or sell a non-financial item that was entered into and continues to be held for the entity's own use. Now, these own use contracts are then out of the scope of IFRS 9 and are treated as executory contracts. If a contract doesn't qualify for this own use exemption, then it must be accounted for as a derivative at fair value under IFRS 9. So if we come back to the nature-dependent electricity contracts, what an entity needs to consider is that if any electricity was sold rather than used for an entity for its own purposes, whether this means that they will still be allowed to take the own use exemption. Now, clearly, nature-dependent electricity can be challenging because the source of the generation of the electricity can't be switched off. So let's take, for example, a wind farm and a contract to deliver electricity from a wind farm. Now, the wind continues to blow at night, and so there may still be delivery of electricity at night, which may be in excess of an entity's requirements, resulting in sales of excess amounts. Now, the challenge with these excess sales are this might mean that it is now precluded from the own use exemption. And similarly, we saw challenges around the hedge accounting and the designation of hedge accounting contracts. So to address these challenges, the IASB has made amendments to IFRS 9 and IFRS 7.
So the IASB was addressing some rather specific challenges, and I think that explains then why this is a set of narrow scope amendments. I think what's really important for our listeners is to understand that the amendments only apply to contracts that reference nature-dependent electricity. And those are contracts that expose an entity to variability in an underlying amount of electricity because the source of electricity generation depends on uncontrollable natural conditions, typically associated with renewable energy sources such as sun and wind. Other contracts, for example, contracts for electricity generated from biofuel are not within the scope of the amendments because such electricity generation is not subject to the same uncertainty as solar or wind contracts. And then you get the in-between scenario, which is hydroelectricity. That's far less clear-cut. If the electricity is generated from a dam, where the flow of the water can be controlled to align to demand, then there's no exposure to variability in the amount of electricity, and those contracts would be out of scope of the amendments. But in simpler systems, where there's no ability to control the flow of the water, then there would be exposure to variability, and those contracts would be in scope. So that's the first of the scoping challenges that we hear, but there are another two that we thought we'd cover. Laura, why don't you tell us a little bit about how we handle renewable energy certificates and also baseload contracts?
Okay, so on the first bit, the IASB has noted that aspects such as renewable energy certificates or guarantees of origin or similar certificates or schemes or accreditations, those are outside the scope of the amendments. Moving on to the second question of contracts for a fixed amount of electricity or a baseload contract. Now, on the surface, it may seem that because these contracts are for a fixed amount, they actually remove the risk of variability and therefore they would be precluded from the scope of the amendments. However, Let's take an example of a contract for the delivery of 100 units, and it's capped at 100 units per day, which is in line with the entity's expected daily usage. Now, the delivery of electricity happens at specified intervals throughout the day, and there may be a risk that the amount delivered at a particular interval exceeds the entity's electricity needs at that particular time, resulting in sales of excess electricity. So therefore, even though the daily amount is fixed, at specific intervals, there may be sales of excess amounts required. And therefore, as such, these contracts are not automatically precluded, but may still be eligible for the own use exception if the other scoping requirements are met. So now we've discussed which contracts are in scope. Callum, can you take us through what the actual amendments are relating to the own use exemption?
So the amendments say that when an entity evaluates these contracts for the own use exemption, the entity should assess if it has been the amendments term a net purchaser over a reasonable period of time. If that's the case, then the contract is out of scope of IFRS 9 and treated as an executory contract.
Okay, so Callum, there's some new terms there. Can you take us through what is meant by net purchaser and a reasonable amount of time?
Yeah, so an entity would be a net purchaser if it buys sufficient electricity to offset the sales of unused electricity. And that assessment needs to be made over what the standard refers to as a reasonable amount of time. In order to determine what a reasonable amount of time is, the entity should consider the variability of the amount of electricity generated due to the seasonal cycle of natural conditions and the variability in the entity's demand for electricity due to its operating cycle. So for example, if more electricity is generated in summer than in winter, a reasonable amount of time might be 12 months, covering the differing variability in summer and in winter. But importantly, the amendments are very clear that a reasonable amount of time cannot exceed 12 months.
Okay, so that is interesting because in effect it means that a contract may now qualify for the own use exemption even if it results in frequent and substantial sales, if it remains a net purchaser over a reasonable amount of time. And this explains why there was so much disagreement over these amendments, as in effect it results in a concession to a long-held IFRS 9 principle that if a contract results in sales or cash settlement, then it is in the scope of IFRS 9. So in effect, the amendments create an exception to an exception. Now, it's important to remember that there needs to be ongoing assessment over the life of the contract to ensure that the contract continues to meet the own use exception. But this is a one-direction test. So what this means is that after inception, a contract can't become own use. But if after inception a contract no longer qualifies for the own use exception, it is then reclassified prospectively as a derivative under IFRS 9. Now, the amendments state that an entity must have no practical ability to avoid making sales of unused electricity. Callum, will you take us through what this means in practice and, for example, what the impact of technological developments might be, say, of batteries, on an entity's practical ability to store unused electricity?
That's a great question, Laura. So firstly, the first thing to point out is that practical ability is not defined in the standard. We expect that economic feasibility will be a massive part of making that judgment, but it will remain a judgment. And exactly where the tipping point is to when something becomes economically, technologically feasible and all of these things is likely to be very judgmental. So as an example, if you take an entity that's receiving electricity from a wind farm, currently the cost of batteries might be too high for it to economically buy those batteries, store the power and thereby avoid the excess sales. But as technology develops, it may be that the price of batteries or the capabilities of those batteries improves to the point where actually the entity does now have the practical ability to purchase those batteries. It's economically feasible, technologically feasible to install them and avoid those sales. And if that's the case, or if that becomes the case midway through the contract, then that contract would at that point in time become precluded from applying the IFRS 9 scope exemption.
What if an entity can store some but not all of the electricity?
Yeah, so Laura, that's an important question. If an entity can only store some of the electricity and doesn't have the practical ability to store all of the electricity, and as a result it still has some sales of excess electricity, then the contract would still be eligible for the own use exemption. So maybe if I say it in different words, if the entity has done all that it practically can to avoid making excess sales, but there's still some sales, those sales won't preclude the entity from taking the own use exemption.
Okay, so now let's move on to the other main changes that were made to IFRS 9 as part of the amendments, and these relate to the updates that were made to hedge accounting. Callum, will you take us through this?
Yeah, and entities are increasingly using contracts for nature-dependent electricity to fix the price at which electricity will be sold or purchased in the future. Now, the challenge under pre-existing IFRS 9 is that the standard required the hedged item to be designated as a specified nominal amount or volume. So any changes to that nominal amount of volume of the hedging instrument couldn't be automatically reflected in the hedged item. That meant that entities had to come up with workaround strategies, and they typically resulted in a degree of ineffectiveness. So these kinds of adjustments to align the two volumes could have resulted in new hedges or adjustments to the entity's risk management objective, and the latter in particular could have resulted in full or partial discontinuation of the hedging relationship. Neither of these outcomes were ideal. So, to overcome this, the amendments will now allow an entity designating a contract referencing nature-dependent electricity, so there's that narrow scope again, as the hedging instrument in a hedge of forecast electricity transactions, to designate a variable nominal amount of forecast electricity transactions as the hedged item. You get variability in the hedged item, that's the big change. In terms of practical considerations, the other hedge accounting requirements in IFRS 9 continue to apply unchanged, such as hedge effectiveness and the actual hedge criteria in the first place. So that helps massively on the volume side, but entities should still be aware that there could be other sources of ineffectiveness in the relationship. For example, the ineffectiveness arising due to basis or structural price risk. Now, if all of this is very wordy, there is a helpful example that's been added to the illustrative examples to demonstrate a way in which these amendments could be applied. So, Laura, would you then, as we move on from hedge accounting, would you take us through the effective date of the amendments and also the transitional provisions that come along with them?
The amendments are effective for annual reporting periods beginning on or after 1 January 2026. Early adoption is permitted, but this must be disclosed and may be subject to local endorsement. The date of initial application must be the beginning of a reporting period, which might be a reporting period other than an annual reporting period. Now, the amendments relating to the own use exception must be applied retrospectively. An entity is not required to restate prior periods, but if it does so, it can't use hindsight. If prior periods are not restated, then any difference between the previous carrying amounts and the carrying amounts at the date of initial application is then recognized in opening retained earnings at the beginning of that reporting period. Now, interesting, the hedge accounting amendments must be applied prospectively to new hedge accounting relationships designated on or after the date of initial application. An entity is permitted to discontinue a hedging relationship in which an in-scope contract has been designated as the hedging instrument if the same hedging instrument is then designated in a new relationship under the amendments. So to summarize, retrospective application for the own use amendments and prospective application for the hedge accounting amendments.
Thank you, Laura. And that brings us to the end of what we wanted to share with you relating to the amendments today. I hope you found this session useful in understanding the amendments and the practical considerations that you may want to start evaluating as you prepare for your implementation journey in 2025 and 2026.